Today, I want to talk about a massive short squeeze that just happened in ZURA Bio. Now, this short squeeze was caused by a name and CUSIP number change, which is the exact same thing that AMC will experience as soon as this lawsuit is thrown out as frivolous. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, as you can see, the exchange tweeted saying that ZURA completed a name and CUSIP number change, and the stock hit a new all-time high with a 314% run today alone. The stock closed on Tuesday at $7.24. Now, after that name and CUSIP change through Wednesday, it rocketed to $30 per share. Now, ZURA Bio didn't go through a reverse split or a conversion, but the main thing that happened to ZURA was obviously this CUSIP change. During a reverse split, AMC will also be changing their CUSIP number as well, so it could have a similar 314% run after the 10-for-1 reverse split. While AMC could go from $6 to say $30 or $40 after the reverse split, it could then run an additional 300% on top of that, over $100 per share. Now, what ZURA Bio also did was announce the closing of their business combination with JAT Acquisition Corporation. Now, obviously, as I've spoken about many times on the channel before, AMC may also be going through an acquisition of their own as well. And therefore, the reverse split and CUSIP change or the acquisition of AMC or business combination could end up causing a massive 300% gain just like this. I've spoken a number of times on the channel before on how AMC is likely to merge with Amazon, Netflix, Disney, or potentially Paramount or a number of other acquisitors. AMC also recently changed their articles of incorporation to make it so they could be acquired by an interesting shareholder that already holds shares of AMC. AMC have been working over the last year or two to develop more and more revenue streams to bring billions of dollars to AMC as a company and make it even more interesting and appealing as an acquisition target. Now, on top of that, Base DGen has tweeted about how the ongoing banking crisis or banking collapse has also caused AMC's cost to borrow to rocket once again. As of yesterday, AMC's cost to borrow is showing a cost to borrow maximum again of 1,000%, with a cost to borrow average of 415%. It goes to show these shorts are getting even more desperate to borrow AMC shares at whatever price it costs, even if it costs them on an annual basis 10 times their short position with this cost to borrow maximum. That means that every single month that shorts spend shorting AMC, they're paying around 0.8 to 0.9 times their entire short position on a monthly basis. Now, you may have also been seeing a number of glitches for AMC and APE recently in terms of the shares available or their market capitalization. The most recent one I've seen is this one from Simulation Ape Nation showing a trading view glitch showing the ape market capitalization of $400 billion. A $400 billion market capitalization divided by just under a billion ape shares would give ape a share price of over $400 per share. Again, just another glitch that shows that realistically ape and AMC should be valued significantly higher than they currently are. And as James tweeted, M1 Finance is also showing something similar, but with a different market capitalization. Again, M1 Finance is showing APE with a market cap of $138 billion. I think this all really ties into something very interesting that I saw recently, which is this tweet from Scott. Guys, if you haven't already, be sure to join me over on Moomoo, the sponsor of today's video, by signing up using the link in the description below. You can currently get up to a whopping 17 free stocks, entirely commission-free trading, free level 2 market data, and most importantly of all, Moomoo is very easy to use. They've got tons of technical indicators and advanced charting tools. And with Moomoo, you've also got entirely free 24/7 customer support, and you can also trade around the clock with their full extended trading hours. Scott tweeted saying that TD Ameritrade just told him in a conversation at 4:57 PM in a conversation with Ron Fleming that FINRA halted MMTLP when dark pool trades had hit 100 times its normal value, and they nuked it with the U3 trading halt because the share price bore no resemblance to the actual trading value. This means the price of MMTLP did hit a massive high in a separate off-book trading venue, aka an alternative trading system, or aka a dark pool, and that FINRA halted MMTLP because they were worried about the true price. If the MMTLP stock hit 100 times its normal value in the dark pool, that obviously panicked FINRA and caused them to halt the stock. FINRA obviously excused themselves by saying we did this with a reason because the share price bore no resemblance to the actual trading value. Now, Scott did actually try and get a copy of his audio conversation with Cameron or Ron Fleming, but TD Ameritrade wouldn't comply. TD Ameritrade said in regards to the phone call, we cannot provide a recorded copy of the call. However, Cameron is a specialist on the trade desk who holds his Series 63, his Series 7 and his Series 9 licenses. And they've said that you can also review his information on brokercheck.org. And therefore, clearly Cameron Fleming does know what he's talking about if he is actually a qualified financial advisor or a qualified security specialist. It seems kind of fishy that TD Ameritrade wouldn't provide Scott with a copy of the conversation, but I'm really interested to follow this further and see what actually happens. But in the meantime, as Gavin tweeted, we're seeing yet more hedge funds slumping and collapsing. Gavin tweeted saying that Duran's oil hedge funds slumped 40% as commodities have retrenched. Again, this is yet another hedge fund collapsing that may or not be long or short on AMC, but what it does go to show is that the entire hedge fund industry is struggling massively. Top of this, as G-Man tweeted, he said that GameStop short volume was up by a massive 20 million shares on yesterday's trading alone. This here is a chart that shows the GameStop short interest over the last few weeks or the last few months, which obviously absolutely skyrocketed yesterday after the price of GameStop rocketed as well. Clearly the shorts are trying all they can to push the price back down, and as G-Man tweeted, he said there's nowhere to hide Citadel securities, we see everything you do. I think it will be very interesting to watch the price of GameStop over the next few weeks to see what happens now that GameStop is finally profitable and the shorts are yet digging themselves an even deeper hole. These shorts now know the short thesis makes zero sense because GameStop is a profitable company, especially if GameStop continues to be profitable over the next few quarters as well. As I said, that will lead to smaller hedge funds closing out of their short positions as they know that it makes no financial sense, but obviously you're going to have some hedge funds and market makers like Citadel that double down, triple down and quadruple down on their short positions. And that's obviously because the big boy hedge funds that are in so deep with their synthetic shares can't close out of their short positions without bankrupting the entire fund. And that's how Citadel somehow found an additional 20 million shares yesterday alone to add to their GameStop short position with. Now, I don't think GameStop is 100% utilised like AMC, but it's magical how Citadel Securities and these other liquidity fairies can somehow find even more and more and more shares to short. And finally, as Biotech Moose tweeted, he said the massive toxic debt swap is killing everything it touches. He said first Archegos, then Credit Suisse, and UBS soon. He said it's way bigger and way worse than even we imagine. As Edward Burchuk tweeted, he said the result of failing to report short positions, probably all naked positions, for 7+ years, if not longer, and then, as Archegos tried to do, attempted to hide them all in swaps. He said it was brought to you by Credit Suisse, but sponsored by Bill Huang's family office. You may have also seen that UBS is now trying to back out of the deal as well because of Credit Suisse's separate First Boston deal. Credit Suisse basically wanted to spin out their investment bank into a company called First Boston, and UBS doesn't want any of it. UBS have basically said if that deal goes ahead, they're pulling out of the Credit Suisse acquisition. Whether that's the true reason why they want to pull out of the Credit Suisse acquisition or whether it's because of these toxic swaps, I don't know, but it will be interesting to see exactly what happens. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.